Hi, this is Darius Dale here, Senior Analyst on the Hedgeye Macro team, and today I wanted to show you exactly how we use volatility, not only as an indicator for market sentiment, but also as a predictor of price of both in the immediate and intermediate terms. So starting with this slide here, this diagram. So core to our risk management overlay here at Hedgeye is using not only just a surface area price, but also things like volume and volatility as indicators of a security sort of immediate term price range, but also where a security might, where a market price is likely to trend over the intermediate term. So what is volatility? So volatility is a measure of dispersion on an annualized basis on price changes for a particular given asset or market. And what you see that is that it generally tends to be inversely correlated to price. So typically what you see is when you have higher volatility, higher dispersion, you typically open up at the downside of those particular ranges. But that's how we calculate realized volatility. But more importantly, there's implied volatility, which is the market's expectations of future volatility over a particular time period. So again, realized volatility, how is the securities price got from point A to point B? Is it really volatile or is it not very volatile? Is it low beta, is it high beta? But then also implied volatility. With implied volatility, there's a myriad of indicators that we can use and track on a real-time basis to gauge investor sentiment in the real time. Starting with obviously volatility skew, which is a measure of put and call implied volatility, effective the price investors are willing to pay for puts relative to calls over any given strike or in any given sort of duration. The implied volatility premium, which is something we'll detail further in this presentation, is just a relationship between implied volatility and realized volatility over similar durations. There's dispersion. There's how volatility investors are pricing volatility at the sector level relative to the index and how that's tracked over time as an indicator of a bullishness or bearishness developing on the margin for a particular sector. And then lastly, this term structure with respect to how are investors in pricing volatility expectations for a particular security or asset across the curve, across sort of durations. But again, just looking at this relationship between implied volatility and realized volatility. So again, what we're showing here is this, on the x-axis we have t equals time. This is t0. What we like to look at is the 30-day window, because that tends to be where the biggest amount of delta hedging activity occurs, and it tends to give us the cleanest read on real-time investor sentiment. So here, the t minus 30 days, that's realized volatility. T plus 30 days, that's what the market is pricing volatility, where the market is pricing volatility. And then this is V, the y-axis is obviously the level of volatility. So what you've seen, so let's say the security, this is security A, ticker ABC. Ticker ABC over the last 30 days has had a realized volatility of X, whatever X is. Well, if investors are really concerned about this level of realized volatility, i.e. being complacent, or they think the price could potentially go down a lot, what they'll start to do is hedge and bid up the price for implied volatility over the next 30 days over some time period in the future. So what we'll have here is an implied volatility premium developed. So that's X plus whatever, Y equals relative to this. So fill in the shaded area. That volatility premium to us is a signal that investors are fearful of the price action in this particular security, ticker ABC, over the intermediate term. Conversely, if investors are pricing in implied vol to drop relative to the recent past of what's been realized historically, then we have a implied volatility discount developing. And what that to us is a signal that investors are incrementally complacent or incrementally more sanguine on the outlook for ticker ABC's price. So what we like to do is track this spread over time and see, you get to critical levels and critical pain points to suggest that investors are about as bullish or as bearish as they possibly could be. So let's say this X plus Y has historically traded in this range here. When an X plus Y is at the top end of this range, it's about as fearful as investors could possibly be. And conversely, when it's when the implied volatility discount's really steep, it's a signal to us that investors are actually quite complacent on a particular asset market, certainly relative to the recent past. So to us, that's an immediate term signal to maybe think about fading recent price action or fading consensus expectations in this particular security or asset class. So with that, Darius Dale here, Senior Analyst on the Hedgeye Macro team, just sort of showing you how some of the ways in which we use volatility as core to our risk management overlay.